And welcome to another webinar. It's USA Medical Opportunity, and myself, Willie Olofs, is flying solo tonight. I'm the due diligence and risk assessment manager, and it's my privilege to spend some time with you listeners, and I hope you enjoy what we want to share tonight. It's about our favorite sector, medical, and I'm just going to scroll to our next page, which is our disclaimer. There we go. You should be seeing it in a second or two. So what the disclaimer is just about is that we just wanted to let you know that this is just for information purposes. We are not giving any advice tonight. If you're interested in what you've learned tonight, and you want to partake in one of the opportunities that Wealth Migrate is offering, please consult your investment advisor. And that's just what the disclaimer says. I'm just going to give you a second or two before I carry on, so you familiarize yourself with it. We really want to make sure that we adhere to the regulations. So I'm just going to give you 1 second or two more just to familiarize yourself. All right, yeah, so I think the main idea about this evening is to talk about Wealth Migrate and the medical investment opportunities that we have. And if you are new tonight, I'm just going to run through who Wealth Migrate is and what will work well for who Wealth Migrate is. So let's get cracking. I'm just going to do that so that you don't focus on me, but are able to focus on the slides. So the Wealth Migrate is now in the 3rd year, and as you can see from the numbers, decided that we got members now from over 97 countries. That is come across us and wants to migrate some of their money into the real estate markets. As you can see, we started off initially, the investment hurdle was around $100,000 that you need to come in. See that that transaction average has started to creeping down to 52,000. And our membership base have grown now to 6,000, which we are quite proud of and quite excited, because that means that we are in the position of changing people's lives, and that is our aim, is to really enable the majority of people that don't have the luxury of investing into property and empowering them to invest for themselves in the real estate market. So we're quite excited by that. As you can see, is that we've raised over 57 million. And that's in equity. So that means that our we need to provide equity. We leverage most of our assets. So this is not deal size. The deal size is approximately 300 million. So that's a good chunk of equity that's already been migrated through Wealth Migrate and our platform. So that's just a quick summary as to what Wealth Migrate has done. We've recently been awarded in China, and that's our colleague Hank that's receiving a trophy for the due diligence that we've done here. And so we are quite proud on the due diligence team side of being awarded this award for Medical 5 and the due diligence processes that we follow in providing the investment opportunities for our investors, and I've been honored to receive this in a foreign country for that matter. So that's actually extra special for us, and we're quite excited by having our Chinese team on board and being able to be well represented and achieving some rewards and gaining some momentum. So what our investment strategy is that we look into different sectors, and the favorite sectors that has been established for the last 3 years is the healthcare and multifamily. If you've noticed on the website, unfortunately we don't have a multifamily project as of today, but myself and Michiel and Henny is flying out to the US next week to see if we cannot get some more, not only healthcare properties, but also multifamily properties. This chart is actually from our DLA Piper report. That's actually a number of experts across the US that actually rates what sectors they believe is going to perform well and has performed well in the last year. This stats is actually from 2016, and we are waiting an anticipation for the 2017 to see if healthcare is still the #1 sector, and that's why what this webinar is about, that we're going to talk more about, is the medical opportunities and why we love it. I'll get more into that detail just now. So that's why you would see that we're also looking into industrial, which is mostly your warehousing. We see a lot of activity if you consider now Amazon and the e-commerce growing in the extent that it does. Those guys need some office or warehousing space, and for that reason we will be looking into having some office warehousing hopefully in the not too distant future, as soon as it makes sense and we can get a good deal, as we usually does with the medical office blocks that we are able to partake in. Important thing just to note is that usually for us is that we partner with a established partner, and for that reason it does take a bit longer for us to get into a sector and establish that sector. Most of the listeners that might have been following us would have seen Monty Lee, that is our PPA partner and our multifamily expert. He recently visited South Africa, and since his visit, the Waterridge project actually closed within less than a week. So just from the quality of the partner. So watch out for that space as we grow into some additional sectors. And but we like the medical sector, and what I'm just quickly going to run through is our track record, which is actually just underlying this. I'm not going to go into much detail. The whole purpose of it is just to show to you that we have been in the medical space. So this medical aid project that I'm going to present a bit later, opportunity, is it's actually not our first project. This medical one is our first flagship that we've launched in 2014, and as you can see, is the investment distributions were around 10% annualized that we're able to pay out in Q1. And so that's, as you can see, the projected returns initially when we started off was around 8.3%, and we were able to actually get that up to a better rating just through efficient leasing and actually building out some of the vacancy, adding some value to it. The next one is our asset that's actually performing the best at the moment. It's actually we're reaching 11.22% that has been paid out in Q1. It has also been closed in 2015, so it's also been on the books for a while now. As you probably would have noticed from the first one, it's also in the Atlanta, Georgia area. Then the third building that was finalized January 2016. This has also been doing well in relation to what we projected, is around 8.49%. This is probably one of our beautiful buildings, and it's well located in the Atlanta market. And then we've got the recent asset last year, or our last asset that we've actually bought in Douglasville, which is also in the Atlanta metro area. It had its first pay distribution in Q1, which was 8.29%, which was also a bit above the projected 8% that we achieved or projected for, and was closed in July 2016. Then the most recent medical building that we've closed in May 2017 was Medical 7. That was our first building in Texas, and we should be, the investors that invested in this project should be receiving the first dividend in the next week or two when we finalize the quarter two's dividends. Unfortunately, I cannot speak on what the returns would be. I've not seen it, but it should hopefully be, well, not hopefully, it should be in the region of what we forecasted. Then just for a summary perspective, as you can see, is we've got 5 medical buildings already on the books, and the hurdle rate that we wanted to achieve around 8 to 7%. As you can see, is we've actually been able to achieve that on all of the buildings, and we do foresee that we should on Medical 7 actually achieve that same similar rating or hurdle rate. So as we can see, is that this is the multifamily. This was our first multifamily that we've actually closed in October 2016. It also have been within the projected returns that we've advertised for the first quarter, and we should hopefully be able to continue that during the course of the year. As you might have not known, is that this is sort of a refurb exercise. So we buy a bit of an older building, refurb it, and then that actually gives us a value add that at the end of the day will not only increase your cash flow, but also increase the value add. Then we've got Waterridge Multifamily 3. Multifamily 2 was actually closed quite quickly. So Waterridge is the one I referred to that is been recently closed in this month quite quickly. I see I have a question that I'm just going to field now. What about Medical 4 and 6? Well, Mark, the reason why there was no Medical 4 and 6 was due to the due diligence process that we follow. We get a period when we do the investment. Sorry, I'm just going to keep one back. When we done the due diligence, it was clear that one of the tenants weren't able to actually afford the leases. So we go into scrutinizing the tenants quite well, and for that reason, so how the process usually works is that you put the property under contract, but you do allow for a 45 due diligence period. So you have to put down a deposit first, which is refundable during the 45-day period, and during that period of time we scrutinize everything that we possibly can. I'll run into more of that detail, what that exactly entails, but in short, Medical 4 and 6 actually failed the due diligence that we've done when we, after we initially launched it. So I hope that answers your question, but don't worry, I'm going to explain more into detail as to what exactly it was. All right, so I'm going to carry on now. I just want to quickly just check. Right, so why do we love medical real estate so much? I mean, that's no one likes going to the doctor. I must admit, I'm one of those guys that if I can postpone going to the doctor, I will do so. So in saying this, what we do with our research is we make use of research engines like CBRE, Collier's, Rees, JLL, Marcus, Molchap, CoreLogic in Australia, various research resources, and we continually on a regular basis dive into and trying to understand what's happening in the marketplaces. So CBRE actually said that as an asset class, medical office blocks are recession resistant. What does it mean? It means that when the recession which hit in 2008, what happened is that a lot of people started, there was a lot of activity, construction activity that took place. So there was buildings built, house prices went up because everyone is investing into that. But at one stage or another, that whole process stopped because the interest rate went to such an extent, and the people started being unable to afford those payments. Now, what we also have to know about the 2008 Great Recession was because of the banks being creative, doing subprime mortgage lending, which caused that the people actually paid less for their properties, and then with the intention that because of the value of real estate that usually over amount of time, actually you will have growth in it. That was sort of the reason why the whole market sort of collapsed, because there was people owning property that they actually couldn't afford, and then the bomb payments, much like when you buy a car with a balloon payment, when that kicked in, the market collapsed. Now, in saying this, is that caused the whole hemorrhage on the residential market, which effectively spilled over into your office market, because businesses were unable to pay for their people, and that caused that sort of as a waterfall into the economy. People start losing their jobs. Office blocks starts to lose tenants because they cannot afford the property anymore, and that causes the recession impact that we've seen in 2008. Now, if you consider this, what happens with the medical office block? People still going to be sick, probably going to move, and for that reason, it makes it more resilient in the recession market, because it's not reliant on the job market per se. Yes, there is a certain extent of people that will be unable to afford healthcare if they don't have a job, but for that reason we try to make sure that when we enter a market, specifically in the medical office block space, there is enough people that will be able to afford that. So we won't be buying a building that's in an area that actually to afford healthcare in that particular area. So just keep that in mind. And that's also one of the reasons why we probably won't have a property in the UK in the medical office block space, because they've got a national health insurance, which is actually it doesn't really make sense to have additional facilities like we have this opportunity now. So we've got a great opportunity. So what we discuss here on the medical real estate space is mostly related to the US economy. So JLL's view is long-term market fundamentals will remain favorable for real estate investors. This is actually their projections for 2017. Yes, we're halfway, half year now, and we should be seeing some new reports coming out. But from all the reports that I've actually drawn in the last week or two, nothing is convincing me that this trend is not going to stay on track. The reason behind that is because doctors actually are generally good tenants and will usually sign long-term leases because they are driven by a high tenant installation cost initially to set up all their. They have to have specific things depending on their speciality that they will require in a tenant installation, which means that they're not probably going to be able to or want to pay additional cost in moving every 2 or 5 years. So that's why they usually sign a 10 to a 20 year. And it's also driven by patient geography, client retention, because they settle into a neighborhood. They probably go through 2 or 3 families where they in that particular area. As well as if we look into specialty area, you've got your machinery, imaging. It's sensitive equipment. It doesn't want to be moved. So once it's installed, it's installed. So and what we also like specifically in the Atlanta area is that you get a certificate of need. So that means that there's not another health practice that's going to pop up with the same expertise that you've got. That you need to apply for that. So that makes it actually far more mitigating that competition risk, if you want to call it that. So the tenant demand is also fueled by the demographic trends rather than economic growth. That's what I explained by the recession proof. Within the border of the US and office market, it should remain an attractive niche in 2017, and through the long term benefiting from demographic trends, increased healthcare utilization and spillover from ongoing expansion in the life sciences industries. So what CBRE is saying is that even though the technology changes to such an extent that it extends our life to a certain extent, and people actually will make use less of medical facilities, this change that also are happening is also still promoting medical healthcare. It's just evolving. So that's just an important thing to keep in mind, is that it will always morph with technology changes, because people are still going to be sick, and some people will probably not be wanting to using that new technology that's on the market, you know. So still skeptical, I would say. So medical office blocks are well positioned to capture more foreign dollars in 2017 as buyers seek out higher yields. So what we see is that in markets like the UK and the Europe, those markets still don't is just starting to pick up. So what you see is that people are still looking for asset that generates good cash flow, where they can actually park their money, and that's why you see a lot of medical office block investments from foreign people wanting to go into the market, much like Wealth Migrate does. So if we look into the market in more detail, there's a lot of people that or let me rephrase this. Obamacare and the Affordable Care Act has been publicized quite well this last couple of months. I know they're looking to vote again on it this week. They've actually even got the senator out of his sick bed to come and vote to try and make changes to the Affordable Act from the Trump guys, the team. But the thing that mitigates this for us is the fact that the population of the US is 325 million people strong, and it's projected still to grow by 23% by 2050. The population growth of the population of over 65, as you can see from the stat to the right, is also quite substantial, and it's going to double by the year 2050. So what we still see because of that is that there's a lot of change in the market with outpatient care. So the doctors are moving into the demographic areas, and that's what you will see by this opportunities. It's actually moved closer to where there's a wealthy neighborhood developing. So currently there's no medical facility there, and that's what you're seeing, is that the medical market is also moving closer to that spaces. I've actually just read an article earlier today about what they call micro-medical, actually. I think it's called medical. Where is that note of mine? But that's yeah, tiny hospitals blend acuity, affordability, and accessibility. They call it, yeah, micro hospitals. So there's a continued change happening in the healthcare space, but because of the enormity of it and people's need to be healthy, there's preventative measures that needs to take place, and that's where the care delivery model is starting to change by the baby boomers and millennial generation that actually accepts these new changes and evolving in the modern medicine. And what is great about this opportunity that we also are bringing in and talking about tonight is that it's a new building. It's in a new area. It's also what the market wants. They want a newer property with all the modern amenities to actually make sure that they actually can support these the new generation of millennials coming through, understanding the new technology. So what I actually excluded from the Affordable Care Act is that out of this 325 million people, 86% of them already has some sort of medical care. And that's what's great about a medical office block, is the fact that that is supported by the numbers of people that has got some sort of medical insurance. So it doesn't come mostly out of their pocket. But in the case where with the Affordable Care Act, the idea is to actually make some changes that actually will allow people to actually still have medical care, but will cost the government a bit less, which essentially will create more jobs, which will put more money back into the economy, which will actually enable those people to be able to afford healthcare insurance on their own. So that's the way I see Obamacare. But we're watching it carefully, and we will adjust it. We've got our independent investment committee that on a regular basis look into what happens in the market and adjust as we go on. So now I've set the table. So let's look at the future project. For those that probably have not seen it, it's called ASC Medical Aid. Now the ASC, just so that you know what it stands for, is Austin Street Capital. Austin Street Capital is the capital arm of Hattrick Developments. So I'll talk a bit more about detail into Hattrick Developments a bit later. But in essence, what it amounts to is that they develop the property, and once it's stabilized, so this building is built in 2014 with 10-year leases in place. It's a 3-story building, about 34,600 square feet of gross lettable area, and they stabilized this asset with long-term leases in place that is triple net. So what is triple net? Triple net is when you actually they sign that they actually pay a particular portion, which is in this scenario, I think it's around $14 per square foot for your utilities, water, lights, and share space. If in a case that by year end the utility bill actually ran up because for some reason the tenant actually forgot the tap open, so now the water bill ran up, you can actually charge the tenant, and that's what makes triple net leases so great, is that we can actually beforehand we can actually establish what the returns will be, because the expenses are to a certain extent capped. Now this building, as I mentioned earlier, is in Texas, and I must admit I love Texas, not just because it's an at-will state. So it means what at-will means is that it is a state where you have the ability to fire someone, which means that you can do proper business. It's not a long-winded process like in South Africa, where you need to go to this court and that court before you are able to get rid of a deadwood that is actually costing your business money. It means that they want to do business, and that's what we're seeing is they've actually capped their medical malpractice. That means the doctors can do business, and that's what we like as well, is that because when the doctor makes money, it means we as a property owner makes money because he pays his rent on time, and if his business goes well, his practice goes well, let me just restate that, then you would love to have more space, which means that we add value to the property, and that's great for business. What's important for us is the population growth, and that gets stimulated, and we've probably dealt or explained this on numerous occasions, is that because of the no state income tax or good in transfer tax, this is actually drawing a lot of big businesses from the northern parts of the US to actually move into Texas, which means we see population growth, not just by births, but by migration from other parts of the country, because people want to do business. And that's why you see an economic output that exceeds over $1 trillion. It's the largest exporter of goods in the USA, grossing more than $206 billion a year in trade. It's the second largest population in the US, Texas as a whole. And most of this is these people are actually in Dallas, Fort Worth, San Antonio, Houston, and Austin. If you picked up, I probably didn't said it, but the multifamily one is in Houston. We've got this building in Austin, and we've got Medical 7 that is in Dallas. So we are now just looking for a good opportunity for San Antonio. Then we've actually got the Texaplex covered. The reason why this is so sought after is because of the hotspot of innovation and opportunity and growth that is happening in the Texaplex. That is actually made up, if you look on the card, you will see it looks like you can almost draw a triangle around Dallas-Fort Worth in the north, to the west, San Antonio, and then Houston to the east side, and Austin is sort of fitting in between San Antonio and Dallas. Now, what we've also seen in on our research is that in the last couple of years that Dallas and Houston and San Antonio has been always on the top fastest growing cities and top 10 most populous cities in the US, and the population is forecasted to grow by more than 40 million by 2030. So that's important for us. You would note that we've got what we call a GIBS rating, and that's one of the boxes for our GIBS rating is landlord friendliness, and that's what we like about the malpractice that is capped, and that it's an at-will state. So that ticks our GIBS box, and we can probably give that a 9 out of 10 because of the location of the state itself. So let's talk a bit more about Austin. So Austin is the capital of Texas. For those who don't know that, it's the live music capital of the world. 70% of the city's $600 budget is spent on police, fire, and emergency services. So that means that the city is in proper working order. It's also making up on the employment side. It's the largest sector for Austin. It's about 19% of it is actually made up by the government. The other portions are broken up between trade and transport and utility sector that actually makes up 18%. And that's also what we like. As you can see, we like a well-diversified economy and not relying just on one sector. And that's what's great for us is that Austin is performing in all these areas. They've got technology going for the pharmaceuticals, biotech industries, and what's another thing that's awesome, amazing, why the city is so booming is the low cost of living. And now that's one of the reasons why it's such a great place where this property is located. It's in the suburb called Manor. I call it a suburb because it falls within the metro of Austin, and it's the wealthiest. Sorry, I'm just looking for my note where I made it. So it's the property is at the entrance of the wealthiest master plan community, which is called Shadow Glen. So that's why the building is called Shadow Glen, and it's over 1,400 acres planned unit development. I think it's over 3,000 houses that's going to be built there and is in process of being built. So it's still developing. So we're seeing that the city of Austin is sort of creeping up to that Manor suburb. And what is important to note is that because of this influx of people coming into the city because of the low cost of living, a lot of the established people are looking for a bit of a stretch out, and so you see them moving into these what do you call it? What do they call it? Sorry, I'm just looking for my word now. Community. It's a planned gated community in that area. So that's which is also driving the medical. So they need to a medical facility, and this property of us is basically bringing the need to them because it's got an urgent care in surgical centers, that's got a MRI facility, they've got a pharmacy there, so all the basic health needs are being met by this particular building of ours. It's even got a burn unit in there, and 41% of this building is actually made up by a doctors group that's called Arise. Now, Arise have been recently bought over by Surgical Care Affiliates, which has been bought over, I think it was around February, March, by United Healthcare. So we've actually seen how the building demographic is going to change a bit, but we've got a solid lease agreement in place, which actually will make sure that we do our 95% leased out. So the property is actually, there is a small portion that we've got under a master lease, as well as we forecasted some portion of it because it's a shared unit in the property, and it's been discovered when the financials have been closed the end of last year that that particular suite is not performing well enough by being a shared suite. So our partner on the ground is looking to actually replace that by a secure tenant that's got a proper lease for at least 5 years to be in place. So we will see some value add to this building by leasing it up from 95% vacant to 100%, and that's why we should be able to have a continuous average of around 8.4%. It's obviously not, if you follow the brochure, you'll see it creeps up from the first year to the second and third year as we lease up the building and bringing in new tenants into that space. We should be able to average around 8.4% being paid out quarterly, and we should have the capital growth at the end have an internal rate of return averaging 15.53%. So the internal rate of return, for those that don't know, is a measuring tool to actually establish if this particular asset, how does it compare with another asset. So the 15.53% is not what you're going to get. It's basically just taking the 8.4% average and adding the capital gain that you get in year 5, and that basically takes in consideration the time value of money, and that'll offer you a return of 15.53%. This is what how you can compare it against some new developments, opportunities that come online. Then you can see if, how does it measure. For interest sake, is that the multifamily Waterridge that we closed, that's internal rate was 18.83%. The main difference between these assets is because this is what we see as a capital preservation asset, where the multifamily is more a value add asset, where you buy a building that needs some work, do some renovation, have a bit of an uplift, so you have additional income coming in. While on the medical side, we see it as a great asset that gives you good value for money. The risk is a bit lower because it's established tenants that's in there, and you get a good cash flow on it. If there's a bit of, because of this, there's a bit of value add in leasing it up, but there's not going to be substantial growth to it, or there could be, depending on what happens in 5 years. A lot can change in that time, so we could see some improvements, but there's not a lot that we can do to add value to the building. So it's all going to be dependent on the capitalization rate when we exit the building. So the deal value, as you can see, is 11 million, and the equity that we require will be 4 million, and the duration will be 5 years. So let's have a quick look at the pictures. So as you can see on the right hand, it's actually as you come into the building to the right, there's still development that needs to take place. At the back of it, you can see a lot of houses that has been built, and then on the opposite side there's a Walmart. So what we like is when we know a Walmart moves in, they are there to accommodate all the feet, and they will not move into a space where they actually know they will be successful. So as you can see, it's a quite good-looking building, and myself and Michiel has been there a couple of times now, and it's well crafted, and it's well rounded off inside. As you can see, you've got a good pretty chandeliers hanging from the roofs, well built, and we're quite proud to be able to partner with this building. But this is just the existing lease expirations. As you can see, there's a portion of around 20% that expires in 2017. That's basically just the tenants that we're rolling over. It's part of the master lease, so we just brought that up just as a precautionary, and we're leasing that the partner is working hard to lease that up and change the tenant mix to make sure that we've got this building tenanted within the next year fully. As you can see, there's 74% of the building is actually expired 2024, which we like. We want that long-term tenants coming in. So what due diligence have we started doing already? We usually do, and coming back to the question, okay, it relates to that. We delve into what the property condition is, the phase 1 environmental site assessment, the appraisal report, the leases, all these different reports. We delve into it. It's roughly, I suspect it differs obviously, but it's around 700 pages that we work through to make sure that what we forecast is been documented on the lease agreement, so we can actually establish that this is what the lease is going to be over 10 years. It's escalating by 3%. So this is what the income should be, everything staying the same. We also look into the property conditions assessment report as to verify that this building is built well. There's not any specific things that we need to look after and that could cost us money in the next couple of years. So for that reason, we look deep into this property conditions report to make sure that we account for that, and if there's any need to go back to the seller to actually obtain some additional capital to make provision for that, we make use of the property assessment report. What's quite interesting as well, for those that don't know, in the US, the banks actually require the seller or the buyer to make provision because of the property condition assessment report for maintenance during the 20-year term of the borrowing. So usually in this scenario, we've got a loan planned for interest only of 24 months and a amortization of 30 years, and we want to fix this rate for at 5% because we're seeing now the America is in a increased interest cycle now, because the economy is starting to tick and they want to keep the inflation rate within specific markers. So we fix the rates, but at the same time, because of the rate, the loan agreement, the bank makes sure that during that course of the loan that there's enough provision made for the property being maintained. So that's why we look into all these different due diligence materials, and we've got a 140-point checklist that we actually work through to qualify the building before we actually move the investors' money over into the investment. So what are the risks that you have to consider, or what we consider? First thing, our objective is always to reduce the capital call risk. So that's the instance where I made mention to earlier, where in the residential market, where people actually got buildings at 100% debt, and the value of the property actually decreased. So the bank went back to them and said to them, listen, you need to pay in now because we don't want the risk, and so you need to pay. So what risks did we look at? So firstly, we've got our tenant risks, which is the failure for them to honor the lease obligation. So what do we do to mitigate this risk? We do proper tenant credit checks. We only look at buildings which have got reputable medical tenants in it. We look at that financials or position of the tenants, much like I explained about medical 4 and 6. We look at long-term leases, and in the debt cover ratio, that we look to be 2 times what the net operating income is. That will actually allow us that if the income decreases by 25%, we are still good to meet our obligations, and the bank won't calling and say that they need additional capital to cover our interest payments because of the value being decreased. So the other thing is the interest rate risk, which as I said earlier, is that the inflation and the Fed is in the process of raising rates. They're actually sitting today and tomorrow. The current expectation is that the interest rates is not going to be hiked now. There has been forecasted for 3 interest hikes during the course of this year. Fortunately, unfortunately, Trump has been able to actually get all these executive orders through the Senate and the House, which means that there might be a good possibility that the interest rate hike that was planned for the end of the year might not take place. But we are reviewing that, and for that reason, we want to make sure that we can forecast our returns actively. So for that reason, we fixed the rate for 5 years. The other risk is usually our valuation risks. That's usually economic conditions that changes, much like in South Africa, where you suddenly now got a country that's got junk status. So now debt starts becoming more expensive. Businesses starts having a bit of a problem, which effectively causes you to start seeing problems. So for that reason, we've made the decision that we're not going to borrow to the hilt. We're rather going to lower our gearing. The lower gearing means that we are borrowing less. In the past, we would look at assets of over 70% borrowing. Now we're only borrowing around 65, and if we can do less, then we do that. As I explained earlier, the debt cover ratio also ensures us that if you can cover your interest, if your income actually covers your interest, your debt twice, that'll actually make sure you've got a buffer in place. And then the other important thing is that we only want to try and do borrowing from lenders like a Capital One, which is a strong bank that's got a proper balance sheet that's not going to give you a call unnecessarily, because their balance sheet is well established. So what is the exit strategy? We plan on holding it for 5 years. During the holding period, the Independent Investment Committee will continually review the market conditions, and if the market conditions allows us to sell it, we will consider the best exit opportunity for the investors. If, for instance, we reach the point where it's 5 years, again, the market conditions will be assessed. If it's favorable to exit, that will the committee will proceed with the exit procedures. Or if Wealth Migrate receives a favorable unsolicited offer at that period of time, or if the market conditions indicates to postpone the exit, the Independent Investment Committee will consider that option as well, always looking after the best interest of the investors. So as I said, we've got our GIDS rating system, and that's based, as I just sort of walked through, so is looking at the location, the country needing to be landlord friendly, majority of tenants need to be in place, there needs to be triple net leases, the age of the building, if there's a value added possibility, the population growth, the financials, meaning the average lease duration and the tenant quality, and our sector preference, that is actually medical. But finally, the most important thing for us is our partner on the ground. That's, like I said, is Hattrick Developments. They develop the property, stabilize the asset, and then they sell it off and still stay in it because they've got so much pride in their particular product. They like to stay in as well. So they give us the opportunity to raise equity to partake in the property, to enable them to roll that equity again into new property developments, and hopefully in the next couple of months we can actually bring another awesome opportunity from the Hattrick Development stable in Austin Street Capital. Reason being why we like them, why we've approved them as a partner, They've got over 25 years experience in the medical industry. They're a niche player. Why they're a niche player? They actually got a following of doctor groups. So you'll find usually in most of the other buildings, they've got the same sort of tenant doctor mix, if you want to call that. So they basically they've got a following. They also will sponsor the debt. They've got an available pipeline of deals, and they've been able to successfully managing most of these properties. So they are well established, and we've actually built this relationship for the past 2 years now. And we are hoping in the trip that we are going on next week to actually secure 1 or 2 other properties from Hattrick, and we are quite excited about that. So that's in summary what I wanted to walk through. So I'm just gonna give you guys the opportunity now to also ask some questions. I've actually seen there's a whole string of questions that actually came through. So let me just quickly have a look as to what the questions are. So just give me a second. I struggle with the multitasking and talking and reading at the same time. So so I see the first question: will the capital growth on the exit also be paid out as a dividend? Yes, all projects money will be paid out if they go through the Tropics or through the platform. The capital growth will be paid out as a dividend, because the capital growth taxes will be actually paid in the US before the money leaves the shore. Then let me check. Frank has been answered. Would it be better an amount instead of a monthly installment, or could you stop a monthly installment? Nick, yes. So this is a good question. I think what we aim at Wealth Migrate is to provide the potential investor with a number of opportunities. What effectively will happen over here is that this opportunity is only limited time based. So what you will see is that we've got a closing date, I think, planned for the 15th of August, which means that during the 15th of August till now, it's not a lot of days, but during that time you can actually have, if it's 2 or 3 months that we raise the cap, then you can actually have a monthly installment plan for this particular building. But the reality of it is that this is an opportunity that happens. That's once we have circumstances where in some instances we might have more capital coming available during the course of the investment because of someone that is looking or needing to exit the deal, and only then you will be able to partake again. But in reality, you will be able to do monthly investments, but that's the chances are very good that you will probably not be in the same building as we've got now available. So I hope that answers your question. Then okay, yeah. Hildrich is asking, why do we exit these? Why do we exit the deals if you get such good returns? Well, it's to make sure that you do get these returns. So the idea is that we want to empower the investor to actually grow your capital. So for us, it's important that you do get a good cash flow, good income from these investment opportunities during the course of the investment period that we plan. But at the end of the day, if you are able to actually get some money in 5 years with your money back with capital growth of a 20 to 30%, that means that your capital is effectively have grown, and you can actually reinvest that into a new asset with the opportunity in 5 years to add additional 30% again on that 130 that you got back. So for us, it's to ensure that you can have proper capital growth through real estate investments. There might be the opportunity that if the asset is doing well and enough people want to stay in, those that don't want to stay in, we can probably then refinance it, as I explained to Nick, that could be something that we can consider. But for us, it's important that we assist the investor to actually not only protect their wealth, but also grow their wealth. So I hope that answers your question. What is the reason for the previous medical building having a return of around 11 and the rest of are around 8%? So Francis, yes, the reason for that is that when the asset was bought, I think it was probably a month or two after that, one of the tenants actually requested it, that they wanted to build out their suite and actually had some additional tenant installation requirements that caused the rental income to grow because of that. So that is the reason why that asset is doing so well, is that we actually bought it at a good price and had the ability to quite quickly lease it up 100% and add some value to it, which actually gave us the opportunity to increase it to 11%. The other important thing that I also just want to mention at this point is that we want to make sure that we're also quite conservative, and we'd rather want to make sure that we actually reach our hurdle rate of 8% than over forecasting. So most of the assets during the course of the holding period will actually reach above 8% is what we intend to. And in most instances, most of the buildings that we intend to invest in has got some sort of value play, that there's a value added proposition that actually will increase your returns over the period of the investment. But yeah, medical too is definitely our golden star, and the timing was right, and that for that reason it's actually performing so well. Are you guaranteed your investment plus interest earned as soon as the 5 years period is done? Nick, like I explained, I think I probably touched on it on the exit planning. I didn't check the timing of this question, but I'll just repeat that. So no, it's not going to be a case where the timer is ticked off. It's exact five years from now, and you get your money back and the interest rate. The reality of it is that we will continue to make sure that the market conditions actually meets the criteria, and to make sure that you as an investor actually get the returns that we firstly forecasted, and secondly that is actually market related, and if for the reason that it actually makes sense for us to hold it a bit further, a bit longer, we will definitely communicate that and make sure that you as an investor actually gets the best deal out of it. So we will. The strategy is that we will definitely not we will not wait till the last day of the 5-year term. We will probably start investigating in year 4 as to the market conditions and the anticipated exit. Do you need to invest via a US investment vehicle like an LLC? James, no, that's a good question. When we initially started, we had the only ability to allow people that with an LLC to invest in this opportunity. But since last year, we've actually developed the platform to such an extent where you as an investor can, as little as $1,000 or $1,000 invest without any other than your KYCs directly onto the platform, opening up the account, and there you go. So there's no need for an LLC. If you have an LLC, you may still make use of it. We will accommodate you through our Jumpstart or Fund America partner, but that's also the process will be clearly indicated through our platform. I hope that clarifies that. How do you invest and how much? You never say a word about it. Danita, yes, I think that's where the consultants come in. I'm going to I'm going to let me do it this way. I'm going to actually change the slide over, and I thank you guys enough. So that's the next steps. Thanks for that question, Danita. I hope this actually answers that question for you. So you sign up, register, and gain access to carefully selected real estate investment opportunities. The sign up is actually on wealthmigrate.com. Select the investment, choose the investment that suits your investment profile in property type, location, risk tolerance, and return goals. Transact online by completing the investment process online, including signing and uploading your legal documents. That's your KYC or proof of address, and then managing your portfolio all online. So I hope that answers that question, Danita. Thanks for pointing that out. I'll make a note of that. So Alan, for US residents, are quarterly dividends paid net after federal and state tax deductions? Well, if you are in the US and you're making use of your US structure, we will be withholding the tax, yes. Are there other financial partners involved with that trick in this investment? No, just the bank, Dennis. There's no other financial partners involved. Also, do you have US-based offices? Yes, Frank, we do. We've got a office in Atlanta. So there's, and we are actually building out our team on the ground in the US as we speak. That's one of the reasons why we are going to the US next week. So we're actually building out our team there on the US ground, but we have got a US number there. Last day to invest. It's a difficult answer, Frank. If you raise the capital beforehand, we are aiming for 15th of August. So that's our date. But I think the last date would probably be 31st of August. But my suggestion would be for the potential investors, after you've actually gained advice from your advisors, that you rather go to the secure sites and register your interest, so that you don't miss out, and that there's an investment consultant that can actually look after you and maybe just keep you updated as to where the process is in raising the capital. We have seen a situation where we had a recent situation with Waterridge, where we actually raised the capital within a couple of days, and there was a lot of investors that was very unhappy because they've missed out on the opportunity. So for that reason, I want to encourage you to seek your advice and to register your interest and get the documentations ready and contact a consultant. Francis, I think the question you've asked, I've communicated that to you in an email before. The SA Trust Investment Offshore Investment Platform. My answer is still yes, that the SA Trust should be able to invest in that. Do we pay capital gains tax in the US when the building is sold? The entity does pay capital gains tax. US investor gets the returns after capital gains tax have been paid. Yes, Frank, we are registered at the SEC for a Reg D offering. That is completely correct in the US. But that's if you make use of your LLC and you're based in the US. If you go through our platform and make use of our topics, then we are in the listed environment where the Reg D is not relevant, if you want to call it that. But for our US investors, we are SEC compliant and registered. All right, I think we had some great interaction. I'm going to give an opportunity for one more question, and then I want to sign off. I want to try and keep it in an hour's time. I want to thank each and every one of you that actually participated. It's been great, and I like the questions. We'll make a point of it that we can also answer that, and I hope you enjoyed the webinar. So I don't see any other questions coming in, so I want to wish you a good evening, and may you have a great week further, and hope to see you guys soon on another webinar. So please go to the website, register your interest, and at the same time, register for the other events that we have, so that we can actually assist you to learn more about not just the opportunities, but help you invest better in the future. Have a great evening. Good night.